Good morning, everyone. This is the Monday Market Muse, our first one for 2018. Today is Monday, January 8th, and I'm Jim Riggio. Before we get started, a quick disclaimer. Capital Discussions is not a broker-dealer or investment advisor. The presentation you're about to see is for educational purposes only. We have no way of knowing your situation or what level of risk is appropriate for you. We're not making any trade recommendations. The risk of trading options can be substantial. You should be aware of all risk prior to placing any trades. Any trades that we talk about are computer simulated trades, and your profit will end up varying due to such factors as liquidity, slippage, and commissions. And with that, hello everyone. We're kind of starting 2018 very similar to the way we closed 2017 on an incredibly strong note. A couple of records that we've either broken or we're about to end up breaking. And one of them is this chart that I've shown a whole bunch of times. I use it all the time to start my weekly market analysis for my Volvantage. And okay, I'm just going to put you guys on mute if you're not talking, so please just unmute yourself. I just heard, I don't know if that was a blender or a vacuum machine, but it was definitely an electrical motor. Anyway, I use this chart all the time because it's a big picture, right? The bars are monthly. It shows that when we go into trends, we tend to stay into trends for a period of time. You can end up seeing here that they're usually multiple years. Well, we've been in this uptrend now for multiple years without a real downtrend. We had a year and a half or so where we moved sideways. Remember, monthly bars, but a pretty steep, incline. You can see the other increases that we've had, even bouncing off of the bottom in 2008. You can see the range that we moved up in over a period of time. And here, we were steeper to begin with, and we've accelerated. One of the things that happened, let me highlight it so it's a little bit easier to see. You can end up seeing that we've continued to make higher monthly lows. And we've done this pretty much the same way. We're just not having pullbacks. Later this week, if we don't have a 5% pullback, we're going to end up setting a record for the longest time in the history of the S&P without a 5% pullback. Now, 5% might seem like a lot because a lot of times saying, well, where were we arbitrarily? But the way pullbacks are always measured are from peak to trough. So if you take a look at the intraday high to the intraday low, a lot of times we'll end up having sell-offs. And that had happened once every 3.5 months on average. It's just normal volatility, even in up markets. We'll end up seeing that, but we just haven't seen any for over a year at this point. So that's been a major thing that we've seen. The other record that we ended up setting is the volatility, or the realized volatility. What has the market actually done on a daily basis? What you're looking at, for those of you who hadn't seen this graph before, I updated it through the end of last year. And what we're looking at is the distribution of daily returns. So what we do is we take a look and we break it into 100 evenly spaced buckets. They're each about a half a point apart, a little bit less. And we take a look at if markets moves up 0.1% or down 0.1%, we'll end up putting it in each one of those 100 buckets. You can see the 100 buckets here are down on the bottom with each of the numbers representing, where that bucket starts and ends. And the three different colored lines that you're looking at are really quite telling. Let me explain a little bit here. The blue line, you can see here, the blue line is the history of the entire S&P going back through its origin in 1950. Okay, so we're looking at 68 years worth of data here in this blue line. And it shows you that this is commonly known as the distribution of returns, or the distribution of daily returns. And you can see that the blue line shows that most of the times we don't move very much, and sometimes we move a little bit further. If you take a look at how often we end up having 2% moves up, the answer in the blue line was it would happen, okay, but not very often. If I move this over here so you can see the percentage, and let me just move it to right there. Oh, yeah, that's where I wanted to go. Nope, I have to go back one over. Okay, so you can end up seeing here that, you know, yes, this thing would happen, but it would only happen maybe 1% or 2% of the time that we'd have a 2% move. If you take a look at the bull run that we had, not off of the bottom after 2009, because I wanted to take some of the higher volatility moves out. Because if you remember, we ended up moving up for the total of 2009, but we had a sell-off during the first 3 months. So I wanted to get through that to take out a lot of that volatility because I thought that would skew the results and show that we were more volatile than we actually were in the longer term. Okay, but we had a lot of daily volatility. And so I took a look at the summer of July of 2010 through the end of, not 2017, but of the previous year, at the end of 2016. And this is in the red line, and you can see these statistics right here. I'm going to go to the statistics in the middle. I want to go through the graph first, though. You can see that the distribution of range 1 from mid-2010 to the end of 2016 isn't all that dissimilar to the historical charts of the distribution of returns. I've had many conversations, okay, in the beginning of end of 2016, beginning of 2017, when I noticed that the distribution of returns was starting to change. And with some of my buddies over at EAB, that's the investment group that builds hedges for hedge fund managers and other types of portfolio managers. They were saying, Jim, you're actually claiming that the distribution of returns is changing. It hasn't changed in 100 years, and it hasn't. If I ended up bringing up the, say, the Dow Jones, and I showed you 100 years worth of returns, they're still the same, right? They still look the same. Not too many things happen. Yeah, you look at shorter periods of time, and they might be skewed a little bit up, like you see the red line here, because we had more up days than down days. So you'll see that the red line during this bull market has a few more days over here. It has a few less down days in this period. And so you see these little tweaks to the distribution. You don't see this massive spike in the center like we saw in 2017. What this ends up telling us is that we had many, many, many more days that were in between, let's say, minus 1/4% and plus 1/4, maybe plus a 1/3%. We had many more days where we had very little movement. When you take a look at what would be more normal or normalized, when you say, well, how many days did we have where we had more than a 1% gain, say between a 1 and a 2% gain? The answer is in the green line. We had many fewer of those. The same thing with the drops, right? How many times do we have more than, say, a 0.5% loss, okay, up to a 2% loss? Very, very, very few times during 2017. So when I take a look at the narrowness, okay, or how skinny the bell curve is, right? It's very narrow, but very high. We set a record for the least amount of volatility in a year. Okay, so while we had a very bullish year, the markets were all up, okay, 20%, 30%, depending on the index that you look at, the volatility was almost non-existent. Okay.
That green distribution is also skewed to the right.
Yes. Yeah.
Much more than the standard history.
Right. Without question. Now, if you end up taking a look at the percentage of up days versus down days, that's over here. Okay, so I want you to see, throughout history, okay, up days were about 53% of time, all the time. During this bullish run from 2010 to 2016, the number of up days we had was 54%. Last year, we were 57% up days. the other thing that I want you to end up noticing is if we take a look at, I broke down in the statistics, the average up and down. Okay, so this is the percentage that we would end up having of a move on an up day or a down day. So you can end up seeing that historically, if you take every single day in the history of the S&P, on average, we're up 0.03%. You know, you have up days, you have down days. In a bull market, you're going to expect that to be higher. Okay, like we were in 2010 and 2000 through 2016, we went from 0.03 of history up to 0.05. But look at last year, we went up even more so. So when I take a look at the skew up versus down in terms of not the percentage, right? The percentage was more, but when we moved, we ended up moving more, which means that there are many, many more days where we're just slightly higher. If you take a look at the median moves, right? I have the median moves in both up and down days. You can end up seeing here that our median up move was much smaller than normal. If you take a look at, right, our median up move was 0.19. It was less than half the median up moves in history, well less than half, but so were the down moves. So you had much smaller moves. You also take a look at what the standard deviation move up or down was. Again, the numbers are going to be much, much smaller in 2017. And so by every measurement, every statistical measurement, we had very little movement, but the movement we had was a higher percentage up. And when you take a look at the average, right, because now I'm putting the up days and the down days together. When I take a look at the average, on average, we were also very bullish. So very directional, okay, meaning upward, but also in, you know, in tiny baby steps going up, okay? And from that perspective, when you look at these things, there's not another year that had this type of movement, meaning a bullish upward march over the year with such little volatility. Okay, open it up to conversation. Andrew, I don't know if there are other things that you ended up looking at or you saw, if anybody else wants to type in the chat or discuss.
These, you know, the way you're measuring everything here is uninfluenced by the underlying price. It doesn't
Yes,
matter if the S&P is 100 or, you know, 1,000 or 10,000.
without question. And that's the way you should look at things. Right? You should always look at things in terms of percentages. You know, one of the challenges that I end up seeing is here. Let me see if I have this one here. Okay. Yes, this is it. Okay. If you look at ATRs, okay, Andrew, and I think that this was a really good point. I don't know if this was the point that you were making, but ATRs are absolute, and I'm always looking at percentages.
Well, I know, you know, a lot of people like to look at ATRs, and it's kind of interesting because using the ATR argues for maintaining the same size butterflies, even though the market's much higher.
Mm-hmm. Without question. Here, I want you to take a look at this, these ATRs. And what I did was I drew a range around it. No, there's no science around this. This was just me drawing where I saw the ATRs kind of peak and where they kind of ended up having support. And if you take a look at this, okay, to the naked eye, you can see, you say, well, Jim, I really don't get what you're talking about. If I take a look at the ATRs, you know, they ranged from about 8 to 21, okay, last year. If I go back during this whole period over here, they also ended up staying in the 8 to 21 area. If we go back to this area over here, look, except for little spikes, they really stayed in this area. So how is there less volatility? I don't get it. It's all in this 8 to 21 point range. Here's the thing. You don't look at absolute points. You look at percentage moves. So if we go back over here and take a look at how we stayed in this range, the S&P was at 800, 880, you know, 1,000, okay? Where are we now? We're 3 times higher than that. We're at 2,700 and change. So This, if I measured this in percentage, and Thinkorswim doesn't give me a way to show you ATRs in terms of percentages, at least I don't know of anyway. If you take a look at this in terms of percentages, this is 1/3 the movement that we had back here.
Well, it's like taking your chart and switching it from linear to log scale.
It's to the mathematicians among us, exactly. Okay, to the non-mathematicians, it's different. Okay, don't worry about it. Okay. Yes, but totally. And so when you take a look at 2017, um, it was a historic year. Um, some people have asked, okay, and I've had a lot of conversations with my institutional buddies on this. Is this here to stay? A lot of people say no, volatility will end up coming back, okay, as soon as we have our first bear market, or as soon as we have our first, real pullback, people end up being scared and we'll have volatility shoot up again. And I've said yes, but with an asterisk. And I think that the key to taking a look at what volatility in the future is going to be like, I think we're going to go for long stretches of time where we have this very muted um, volatility where, some people called volatility, 2017 was the year that volatility died. But I think that when we end up having sell-offs, because trades are so crowded, when we have sell-offs, you're going to see sell-offs in a very harsh way. They're going to come very quickly. And I think that the history of the way we end up trading our butterflies will be changed forever. And I think that while we're in these dead zones, um, I think people take more risk than they realize that they're taking. And when we have a pullback, a lot of people are going to get spanked. And there's, by the way, there really isn't an easy way to end up trading this because, my Kevlars suffer in terms of the markets that they do worst in is when we have very little volatility, no pullbacks whatsoever, and we just keep marching higher and higher and higher with very, very low IV. Well, the VIX is at near record lows. The realized volatility of the distribution of returns is at record lows, and we are doing this slow death march higher. I guess if you're a bull, it's not a death march. It's a march to euphoria to the guys who are just bulls. But to folks who end up trading for a living and normally need a little bit of volatility, what it ends up doing is that all of the computers now, they start trading in much, much, much tighter ranges until we have a pullback. And, here is the model, by the way, for what happens when we have a pullback. This was late August 2015. And, we have this very, very tight range. We're moving, and then all of a sudden, we break out of 21, okay, in terms of the ATRs, and we go up to 60, above 60. Because we have 4 days that just are an incredible sell-off. The market sells off more than 10% in 5 days here. And then we have some really big bounces, and volatility starts to end up picking up until it becomes muted again, and then we start all over. Yes, we had U.S. election stuff going on here and Brexit, and so things picked up. But for the most part, okay, what we're seeing is, and it's difficult to end up seeing in this type of chart, okay, going back multiple years on daily, but the bandwidth, if I was to draw channels around this, the channels are much, much, much tighter. Let me show you some of the channels that I'm talking about real quick. Okay, so here is the last couple of years, and I want you to end up focusing on the blue line, right? This blue channel. We had a relatively well-defined channel going up. We kind of, yes, you kind of test different sides. We poked up, but if you take a look over here, the channel really held very well on the upside. I mean, it was definitely the resistance until we broke out in the fall. Once we hit our lows, and I'm going to just highlight this area here and let me do it so this is a little bit easier to see. So let me just do it like this so we can end up seeing from the lows that we ended up having in August. So we move sideways, we hit our lows in late August, and once we end up finding our footing, there's this new channel that ends up starting to move up. Now, once we break a channel, I'll leave it on because many times, look at what happened. Now the bottom of the channel kind of end up acting as resistance, but we kept poking our head back into that upward channel just like we have here. And so that is an incredibly steep, tight channel. Now, if I was to draw it again, I'd obviously have to draw this line. And just if you take a look, there's a pretty clean line on the bottom here also going up. So it's almost like a channel, a wider channel with a center point. But that is a very, very steep upward channel. And we did it without a single 5% pullback. And we did it with setting a historic low in realized volatility. And so, to me, this is it's a challenge. And one of the presentations that I tried to end up doing over the Christmas break and between Christmas and New Year's was how to build a portfolio. There was a mix-up. Tom was the one who sets up the round table. I couldn't start it. I was ready to present that day. I'm sorry you guys didn't have it. We're going to do that this Thursday. And after we're done with questions and stuff, I'll give you a quick preview when we're done. But the key to, I think, any type of successful performance is having trades that work in different types of environments. I've mentioned a couple of times how my Kevlar has struggled. But my Volvantage trade, the one that trades the ETFs on the VIX index or based upon the VIX index, did incredibly well. It had well over 100% year. Our current trade that we're in is up 36%. And we have had an incredible beginning to the 2017. And so you can't have, if you have one trade, you're not going to be very diversified. If you have 27 different trades and they're all short gamma, long theta, that get in trouble when the markets move outside of a particular range, you really have one trade on. You have one type of trade. So you really have to get out of your, I don't want to call it comfort zone, but out of your zone where you keep looking at the same types of trades just on different indexes and things, because what you'll find, and I've been there, guys, what you'll find is you'll find, 5 different trades or 12 different trades that all seem to work great, but they all have the same weakness. And if you all have the same breaking point or weakness, when that market happens, you're in deep trouble. Like, for example, if all of your trades would end up losing money if we suddenly have a big draft in the market. We have a big sell-off and volatility pops and goes from low to high. If you don't have negative delta trades that will end up remaining negative delta for a long enough period of downtime, you're going to get hurt. And then you're going to have to adjust 12 trades, not just one, to get out of them. And so you really have to end up taking a look at the core underlying, I'm going to call it the theory of your trade. But the challenge is it's not just the theory of, hey, if the trade moves here, I'm going to make money. If the trade moves there, I'm going to lose money. It's how does it actually work when you put it into real practice too? A lot of times I know that some people love the concept of saying, hey, a great hedge is to put a butterfly far below the money. Okay. I had a butterfly on when the Greek financial crisis or debt crisis ended up hitting. The Europeans all scrambled, okay, and I happened to have on a Rut butterfly that was something like 10% below the money. Intraday, during the sell-off, the market had gone down so much that it went to the center of my butterfly. Now, you guys know, because if any of you try to end up putting on these butterflies far below the money, you're like, oh, you must have made so much money that the P&L curve moves higher and higher as you get towards the center of that butterfly. And if you were 10% below the money, you must have made a fortune. No, I actually lost money when we were in the center of my butterfly, because what ended up happening is that volatility went up so high, and that my Greeks, they changed, they morphed as the price of the underlying goes down, and as volatility changes, that ended up making my trade a negative Vega trade, even though when I looked at it on the graph when everything was calm in theory and just said, well, if everything stays the way it is and we go down, I'm going to make all this money. Well, it doesn't stay calm as you go down. The volatility changes, the volatility at different strikes change, which means that skew changes. And so how things actually work is very, very different. And the other thing that I can guarantee you is that no two market sell-offs are going to be identical. You know, sometimes you start with lower IV in the center, but the IV is much lower on the puts below. Sometimes there's an event risk and you get a little bump. Everyone's going to be slightly different. And about the only thing you can guarantee is that if you've had a sell-off, you know, you won't have the exact same pattern in a sell-off twice. It just doesn't happen. And so I think that there's a lot of risk in what people end up doing. And so it's important to be able to end up having trades that do well in different environments. Somebody ended up asking if my Volvantage trade can be done with the VIX futures rather than the ETFs. The answer is yes, it can be, but it's a lot of work. Okay. Let's go through one of here. Well, let me just bring it up. It's probably the easiest way to end up showing you. The Vol Vantage trade does one of two things. It either stays in the VXX, which is the long VIX ETF. It's actually an ETN. So I'm going to use the word ETF. And I know some of you guys are going to say, Jim, it's not an ETF, it's an ETN. I know, but everybody knows ETF. So give me this leeway. So it's the long VIX ETF. The XIV, VIX spelled backwards, or VIX spelled inversely, is the inverse VIX. And it basically ends up shorting the VIX, or at least that's what the sales guys or the investment advisors sell it as. But the way it actually works, okay, and let's talk about the, let's talk about the way the VXX actually works. The way they had to build this is that they, meaning the marketeers, okay, and the lawyers, okay, who would make the marketeers only say stuff that was 100% true, even if it is misleading. They'd end up saying, oh, this is a 30-day look forward on the VIX. Now, how do you end up getting 30-day look forward? The answer is you have to end up using futures. Now, remember that the VIX is the only future market that doesn't have an underlying that can be traded. You know, you want to trade oil futures, you want to trade corn futures, you want to end up trading S&P futures, you want to trade interest rate futures, you want to trade any future, there's always going to be a spot or a cash price for it. The challenge with the VIX is that there's a spot price, right? We can calculate what the VIX is, but you can't trade the VIX itself. So that's why these ETFs have become so popular. And so what the ETFs have to do, either with actual futures or with a large financial institution simulating this, what they have to do is that they have to own the first 2-month futures contracts in a proportion that they would end up averaging 30 days. So for example, if we make the math simple, if say one future was 15 days to expiration and another day, and the next future was 45 days to expiration, I know you can't do that. I know you have to have be divisible by 7, but again, you know, give me a little bit of creative leeway here. So if the front month is 15 days and the second month is 45 days, if we own 50-50, right? If we own 50% of the front month and 50% of the back month, we own 50% of the 15-day futures and we own 50% of the 45-day futures, and we average them together, we're at 30 days. Well, what happens tomorrow? Well, that front month futures only's got 14 days left before its settlement date, and the back month only ends up having 44 days to its settlement. So now we're at 29-day average, not a 30-day average. So according to their bylaws or their prospectuses, if you read through the details, what they have to do is they have to get the average back up to 30 days. So what do? They sell some of the shorter term futures and they buy some of the longer term futures. And people say, well, you know, so what? How does that make any difference? Well, the challenge, okay, with that is that usually the front month futures are much less money. What you're looking at here in this aqua color line, and you can see it right up here, the aqua color line, is that it is the front month future, right? And the front month future is the F8, F standing for January, 8 standing for 2018. If you take a look at the green line here, the green is the G8, G standing for February, 8 standing for 2018. So you're looking at the February, the March, the April, the January, okay, in aqua, the February in green, March in aqua, and so on, April, May, and June. So we're looking out 6 months. You can also end up seeing that this was the contract that ended, okay, in December. This contract in the bright blue was, and you can see that up here, was the Z7, Z standing for December. And it expires on the Wednesday, either before or after expiration. It's usually before expiration on the last quarter of each month. It's after expiration. And this expiration is the only day when the VIX and the front month VIX futures will come together or have to come together. They can come together at any time, but this is when they have to come together. Why? Because the settlement price for the VIX futures is actually what the VIX was on settlement day. And so can you run this, okay, with VIX futures? The answer is you could, but every single day you would have to end up, you know, selling. Now this is for the VXX, right? This is for the long VIX. I'm not getting to the one that I'm in, the inverse VIX. So let's make sure that we're all looking in the same direction. So for the long VIX, that means every single day I would have to sell some of these lower priced options and buy some of these higher priced options. And so what ends up happening is that your commissions get to be really big over a period of time. You'll also have, you know, some slippage. Normally, it's not going to be a lot, but it's going to be, you know, a nickel or so. Many times. And so you could run it. And I know, by the way, the reason why I'd want to run it this way too, right? Because the VIX futures have a shorter or have a lower tax rate on the short-term gains. And most of them are, almost all of these things are going to be short-term gains. So I want to pay a lower tax rate. But the problem is that the slippage and the commissions and the daily movement make it hard. Could you end up doing this and systematize it? Yes, you could. But one of the things that ends up happening is that there's so much money in these ETFs, in these VIX-based ETFs at this point, that sometimes the dog is being wagged by its tail, meaning it's not just the VIX that's moving, but it's also all of the money to be made in the bid-ask spreads on these VIX ETFs. And so what I tend to end up doing is saying it's a lot easier. So for example, you know, my current trade on the Vol Vantage, I got into on November 7th for half of it, and the other half I got in like a week later on November 15th. Here, I might as well show it to you. Let me just detach it, bring it up. Okay. So you can end up seeing here are the last two trades. I got a signal to go long here, but it wasn't a very strong signal. And what I had found was that sometimes when I don't get strong signals after we've had this type of movement, better to put on half the position, wait for a better opportunity to end up getting in the rest. And you can see that the market gave that to me. And here was the rest of the position that went on. And so our average price is around 107. We're at 144. And so that's the 36 or 37% gain at this point. Um, Now, the hard thing with this is, when do you get out? When I first started this, these were some day trades. This was the first one when I ended up sending everything to the Vol Vantage or the Kevlar subscribers when I started this, was that I ended up putting on all of my core shares. Whenever you go into a trade, and this is just something that I've picked up over the years of trading, I always think of my trades in two separate parts. I think, what are my core shares? What am I holding for the longer term? Versus what's something that I can end up getting in and out of, where I think that there's an opportunity. Um, and what I'll do is, many times in my long portfolio, I'll establish long positions, and because I plan on holding them for a period of time. But you know what? Sometimes it goes up way too quickly, right off the bat. Well, what I'm going to do is, I'm going to take some trading shares and I'm going to sell them. I have to buy them back from my core shares. And many times later on, I'll get an opportunity to buy back those shares at a cheaper price. Sometimes, okay, my core shares, the market just really hits the stock, but nothing's changed, right? Everything looks really, really strong. And so I may end up adding, well, I'm not buying more core shares, I'm adding trading shares. And when I end up putting on positions, when I put them on, okay, I determine, is this an investment or is this a trade? Okay, is it a core shares or are these trading shares? Never make a trade into an investment. That's how you get killed. Okay, and so what I've tried to do here is that I put on some trading shares here, and then I sold my trading shares, then I added some more trading shares, and then I got out of everything over here. Now the problem when I was holding this with the Kevlar subscribers, because we went from 41 up to, when we got out of this, we got out at 67. Okay. Every time it would go up, people would say, is this the time to sell? Is this the time to sell? And unfortunately, um, because of the volatility of the VIX and the VIX ETFs, the tighter you make your stops, okay, the quicker you will get shaken out of your investment. Okay, so you have to kind of find the proper range to let something have enough wiggle room so that you don't get stopped out right away. Now, I do not use stops. If anybody's heard me do a presentation on the Vol Vantage trade, what I found is that nothing, and I do mean nothing, and we tried everything, works in terms of technical analysis. You can't use oscillators. You know, forget about looking at your MACDs, your trend lines, okay, your Fibonacci's. All of these things, they just don't work. They don't work because this is just pure emotional fear, right? That's what's moving this thing. And so its movement is different and doesn't end up having very clean properties. What does end up working, and the reason why Vol Vantage was up over 100% last year, and has, by the way, that's what it's averaged, over 100%, going back to when we got all of the data in 2004, and we calculated what these indexes would be, these ETFs, long or inverse. What it's averaged, I'm just going to end up putting some people on mute who, there's background. Okay. If you want to talk, just unmute yourself. What we found was that since none of the oscillators, none of the technical analysis ended up working, it really came down to three factors. Okay. The first one was how high the VIX was. And not just the VIX. I'm talking the VIX futures, right? The chart that I showed you before, it was the term structure. What's the 1 month out? What's the 2 month out? What's the 3 month out? How high are each of these? What's the distance between them? What we're in right now, the term I end up using is perfect contango. It's not a, you can't look it up. It's a Reggioism, right? I'm the one who ends up calling it this, because when I'm looking at the distance between the front month and the second month, it's the largest. If I'm looking at the difference between the second month and the third month, it's next largest, and then so on. Yeah, things change a little bit as you go out. Yes, if you have Christmas or a big Fed meeting, these may change, but for the most part, things look very, very clean, and they're going from upper left to lower right. The VIX is below the front month futures, and over the next month, okay, just like here in the blue line, you'll see that there's a nice slow path down. Even if the VIX does pick up a few days in a row, like it did right here at the end of the year, the VIX futures remained flat. They came together, and then they moved down during the last few days. That's very normal. That's what ends up happening, and that is the sign where there's very little volatility. What happens as soon as you pick up in volatility? Well, not only does the VIX start to pick up, but then the term structure starts to get out of whack. If the front month, right, the aqua line right now, if the front month ever goes over the second month, that's what we call going into backwardation. Um, a lot of people think that that's the magic line. It's important, but it's really the entire structure. And there's nothing more important, okay, in the vol vantage trade, or if you're going to end up trading any of the VIX-based products or the VIX futures, is to understand that relationship and that history. We try to end up trading it with options, and we just could not get it to be consistent. Could not, and nothing we do. I mean, we worked for years trying to end up 5 years trying to get options on these ETFs to end up working different types of structures, risk reward, okay, long options, short options. And the problem was that there was just so much noise in the volatility of the volatility. Remember what we're doing. If we're buying options on a VIX-based ETF, well, the VIX-based ETF is a derivative. Okay, it's not even based on the real VIX. It's priced off of the VIX futures, which is another derivative. The VIX is not a calculate. It's not a tradable thing. It's a calculated thing, which is basically another derivative. If you count the number of derivatives you're looking at the options on these VIX-based ETFs, you're up to like six level of derivatives. And every time you do a derivative, a lot of times it introduces the potential for noise. And so trying to end up having something that was consistent using options on these things, I worked on it with two different firms, both of them founded by ex-Goldman Sachs guys. Both of them had their PhD quants. We both spent 2 years on these things, and both projects were abandoned. Okay, we ended up doing some extra work on these things, and what I found was just to end up keeping it simple. And so I trade just the ETF underlyings. I know that there's a possibility that there could be pullbacks. This is a good example where we went into this trade, got in a little bit early, we moved up, and I got out here. Now, yes, I got out after the sell-off or after some of the sell-off. You take a look at all of these sales, okay, when I'm closing the position, not the trading shares, but closing the positions, I'm always going to end up waiting a little bit, okay, and to make sure that it proves. And by the way, and I also have confirmation that the different vol vantage indicators that I use, but it's always going to end up getting into the trade a little bit after it's moved up. It's always going to get out of the trade a little bit after it's moved down, but it's going to capture the biggest chunk of the move. And that's very, very important. Like we could end up selling here and taking our 36% profit, but what's not to say that we do something like we did here, where you move sideways or downward a little bit, but after you move sideways or downward, you move from 59 up to 75. So the fact that I got out at 68 or 67 and change is still going to be better. And so what I found is that the optimal way to end up trading this, and like I said, I spent 5 years of my life working with other people, another year of my life working by myself on this thing. I found what was statistically the optimal way to end up trading this. And right now, long XIV, when I end up telling my Wall Street buddies that I have breakfast with every Sunday, that they're like, "Are you still holding that inverse VIX position? We hit record lows in the VIX again, and you're still short the VIX. How could you be short the VIX? Okay, at a record low. Where do you think it's going to go?" I don't think it's going to go anyplace. What I'm saying is that when I look at the term structure here, okay, this term structure is showing me that there's no risk. Now, here's one of the things that's really important that people don't end up getting. If nothing happens, and I'm just going to make this simple, if nothing happens for an entire month, okay, we're going to continue to sell. Say if we just straight lined, and we can't straight line, but if we straight lined for an entire month, every single day we would have to end up, if we ended up keeping our inverse VIX, okay, because remember, the VIX would end up having to sell this front month and buy this back month. Well, if we're doing the inverse, we're selling this back month and then buying this front month. So every single day we're buying higher and selling lower. And the percentage, I'll do the percentage for you. The percentage between 11.7 and 10.5, it's about 11%. So if nothing happened for an entire month, this wind at our back, okay, so to speak, okay, would give us 11% on this daily roll. Now, there's risk. Is it worth it to take the risk to collect this 11% a month? 11% a month is a lot. And if I end up holding the trade too long, I can lose that 11% literally in a day or two. And it's going to take me a whole month to get it, right? I take these baby steps every single day, and then when the market moves against me, it takes like giant steps against you. The answer is yes right now. Why? Because everything is calm enough. The VIX term structure is calm enough. The VIX itself, and when I look at the VIX, I don't look at just the VIX. I look at the VIX and where the puts are trading, the puts below the money. So we look at a bunch of different ways of skew, right? That's what skew is. Skew isn't telling me that I need to fear. And the other thing that ends up happening that could end up changing this is the how high the volatility is on the VIX options. And if the volatility on the VIX options gets to be very high, that tells me that fear is coming into the market. A lot of times, that might be the first place that you see it creep in. Usually, it's going to end up being term structure. All right. Usually, it's going to be this graph, but sometimes it's the skew on the options for the S&P. And so by looking at all of those, what I found is that the market will end up having some noise. And there are certain limits, okay, certain percentages. I use percentages most of the time. Sometimes I'll use absolute numbers, but almost always percentages. In the volatility indicators that I use to make up a vol vantage, and right now it's long. It could change tomorrow. I don't know. And if you think about this, if I give back a chunk of my gain, I might have to end up closing this trade that's up. It was up 36% at the beginning of the day, and it's up now, so we're probably up what? Let me just check real quick. Yeah, it's about the same. Anyway, so if you take a look at this trade, and even if we have a pullback and I have to get out down here, so what does that mean? I had a 25% gain? You're never going to pick the peaks, okay, to sell, and you're never going to pick the bottoms or the troughs to buy. And so I think that the best way to end up running this trade, the way it's also true about most individual stocks or ETFs that you own, is try to get the meaty part of the move, right? Try to end up getting it so that you're holding for longer periods of time or trading around, right? Because my trade, my core position was to get in here, okay, and get out here 5 months later. And so we had a really nice meaty move where I captured all of this. Could I have gotten out a few days earlier and sold 5 points higher? Yes, if I had a crystal ball and I could pick the absolute top. You don't, I don't, nobody does. So this is the way I end up trading this. Questions, thoughts, anything about other volatility products? Okay, type them in. Andrew, I don't know if you trade these, but
Well,
What do you,
you know, the great thing about the XIV is that volatility doesn't have to go down. All it has to do is stay flat, and it will still make money.
I got news for you. It can even drift up slightly. When we have this big of a difference, okay, in our contango, 11%, that's a big range. That's a really good range between these two. Okay, if you take a look at an absolute points, it's a 1.2 points on a 10.5 denominator. That's a big percentage. So even if volatility creeps up a little bit, like it did here, the VIX went up. We were fine. You know, we moved sideways. We did not lose money. Here, I want you to here. Let me do this so you can actually see, because it's a great point. Oh, I went a little bit too far. Okay, so let me put this up here right next to this. So if you take a look right before the new year, and let's get them so that they're maybe a little bit closer in size. Okay, if you take a look at what happened, okay, and here is the calendar year. And if you take a look at what ended up happening where we kind of had a spike a few days beforehand, right? The VIX definitely moved up, but the range didn't change that much. That's these days right in here. So the VIX actually moved up. It drifted up, right? There's no question up that it drifted up during these 3 days. But because of the way the structure works, and the term structure was so well defined, plus it was also in between Christmas and New Year's, we moved sideways. We didn't move down, right? Normally you'd expect if the VIX goes up, this should come down. That didn't happen. And so could it happen? Well, it depends on a bunch of things. The term structure, like I said, being the most important, but the other things, the skew and the VVIX, the volatility on the VIX options, is also plays a big piece on it. Okay. I'm looking at the time, and we've been going about 50 minutes or so. Any other questions? Okay, let me take just a couple of minutes and last few minutes that we have, and just kind of give you a quick preview on Thursday's presentation that we'll be doing, which is how to build a portfolio. It's going to be Thursday at noon Eastern. There are basically 9 steps to building a portfolio, and this isn't out of any book or anything. This is based on my experience and speaking to a lot of the professional money managers that I've known throughout my life and how they end up doing it. You know, everybody ends up talking about this, but you really have to end up doing it. You know, you need to end up understanding your objectives. Okay, what are you trying to accomplish? What level of risk, okay, can you end up dealing with? You know, you pick your strategies, you back test and stress test and model and do everything. But it really comes down to this, okay? For every single strategy, you have to understand your risk versus your reward. And here's the step that most people end up forgetting in a portfolio. You just don't have one strategy. You have multiple strategies, and you have to determine the risk between those strategies. I break things up into this 9-part tic-tac-toe board. On the vertical axis, I put market direction. Right? And this isn't like scientific. This is me understanding my trades and where I'm going to make money and where I'm going to lose money. It's based, each individual trade is based not only on back testing stuff, but back testing tells me what's happened in the past. I also do modeling to say what's going to end up happening in the future. If this happens, how would it end up affecting my trade? But there's basically 3 pieces to this, and it's, you know, up, down, or sideways. I mean, that's it. And on the volatility, you know, I take a look at what happens when volatility is really high, right? We're having massive ranges up and down, implied volatility is going through the roof. And so volatility can be high, medium, or low. And you have to match all of your strategies to see how they end up doing in different environments. So that's what I've done with my 3, well, I broke it down to 4 different trades, right? I broke my Kevlar into the SPX version and the RUD version. And what I've always said, okay, to all of my subscribers is that the Kevlar's weakest environment, at least in the SPX, the Kevlar's weakest environment is when we have these grind 'em up markets with low volatility. Well, we have historic low volatility, and as we saw in terms of its direction, okay, we're having almost a historic up moves in terms of percentage and our average, okay, up versus down days. Volatility is non-existent, and we've been in an incredibly strong bull market. Well, yes, that does mean that my SPX is going to struggle, but it means that the vol vantage is going to kick butt. Okay, and so understanding the risk reward, that when I ended up adding my two Kevlars together for the year, I'm up a little bit of money. Not a lot, I'm up a little bit of money. But this was the worst environment for the SPX, and the second worst environment for the RUT. But the vol vantage ended up making up for all of it. And then also the long portfolio does, right? The long portfolio ends up doing very well in here. And I'll also end up talking a little bit about the efficiency of, or the efficient use of capital. You know, I changed in 2018. I'm using iron butterflies now for everything instead of put butterflies. And the reason why I do that is I can now have a long equity portfolio using 100% of my capital if I want for my longs, and I can trade the irons on top of it. Because remember, when you open an iron condor, you open an iron butterfly, you open it, you sell it to open. And if you're selling it to open, that means you're collecting cash. Where if I was to buy a put butterfly, I would buy to open and I'd have to pay for it. Well, I'd have to get that cash someplace. And so I still have the same amount of risk, but now I don't have to pay any margin interest. You know, Paul Demers and I used to joke and say, the only religion that we follow is, we'd rather stick needles in our eye than pay margin interest to a big corporation, right? We don't want to pay margin interest. It's ridiculous to pay margin interest. And so what we end up doing is that we end up using irons a lot to overlay on top of our long portfolios. And so it's a very efficient way to end up using. And this way you can end up seeing exactly, okay, where you are in different environments. For example, if we sell off and volatility pops up, I've built my SPX butterfly, okay, different than most, I think, every other butterfly or condor strategy that I know, that it usually does very well when we start to end up pulling back. It also has a strategy where I'll end up taking profits. I'll a lot of times close a profitable trade and then open new ones with much higher volatility, which is a great time to enter, butterfly trades when volatility is high. So instead of locking in losses and opening up a new trade, I'm locking in profits and then repositioning, which it has made, the Kevlar absolutely phenomenal before 2017. And so it does very well, where the RUT butterfly is more of the standard type ones that are a little bit closer to the money, and that one can end up hurting my volatility. But I also know that my vol vantage, okay, will end up switching from not being long XIV, not being in cash, okay, it'll end up being long the VXX, okay, at certain trigger points. So volatility goes, skyrockets, and the market crashes. I know that the vol vantage trade will just print money, right? Print money. And that should end up making up for my other losses. So balancing your portfolio is absolutely key. It's the way you can end up having good years, even though one trade might not have a good year for that specific trade. And so hopefully you guys will have time, or you'll be able to end up joining me on Thursday. Any questions that you guys want to end up asking, or Andrew, any thoughts on this, or any final things before we wrap up?
The only thing I noticed last week in the S&P 500 is there was a pretty good candidate for a buy climax. So we'll have to see what happens this week if we finally get a little bit of a pullback.
Yeah, I saw the same thing. Let me show you. This is my viewpoint, not Andrew's. I know he looks at things a little bit differently. So what ended up happening, if you take a look at, and I don't know if I'm back far enough. I'm probably not. No, I'm not. This is the chart that I put out in the morning for the Volvantage subscribers. I always give them an overview of the market, where it is, what I think in doing on Monday mornings. They get the weekend video. Um, and one of the things that's a bit scary here is that if I end up going back and showing you this longer term, I'm looking at the VIX, I'm sorry, I'm looking at the S&P futures here, but I'm only looking during the trading day. So if there's movement overnight, there are gaps. The two things that I'll point out is, number one, if I go back longer term, I've never seen so many gaps in all my life. There are just so many gaps in the S&P. You see gaps in individual stocks. You tend not to see too many gaps in the S&P 500, just the way the index is and the way it trades. But we had two gaps last week. The other thing that ended up happening that I look at is the MO, the way the market has traded for most of 2017, is that we were making our lows during the morning and our highs during the afternoon, right? Because we were trending higher. And I can go back and I can look very quickly, because what I do is I put the daily highs in low here. The daily lows are in orange. The daily highs are in aqua. So in most of the charts, you can't even see the aqua bar. If you take a look, you see this little tiny blue bar there? That was the high. If you take a look at this little tiny, that was the high. So a lot of times they're so small you can't even see it, but the orange lines are pretty wide. Why? Because we tend to make our lows most of the year. We tend to make our lows in the morning. A lot of times within the first, 15 minutes of trading, usually definitely by noontime. But look at what happened last week. Okay, the last week and a half. We had a whole bunch of times where we made our highs in the morning and we made our lows in the afternoon. And then we ended up having this little sell-off on the last day of the year. And so it did look like, okay, is this the turning point where we'll at least start to form a top and the market will start to sell off? And then this is January 1, and you can see we're off to the races. I want you to remember the January effect. The January effect, for those of you who are big trader almanac guys, will end up saying that I forgot what the exact numbers were, but if you ended up being in the market the first 10 trading days of the year and on the day before a holiday, and there were 10 of those. So if you were in the market for 20 days for the year, you got more than half, and I don't remember what the exact numbers are. I'm sure somebody, if you want, you can look it up. You got more than half the gain with almost no risk. You always have risk, but the risk was minimal compared to the size gain that you have. We're in those first trading days, and there's good reason for it. If you think about all of the money that goes into the market, there's just a ton of money that goes in from pension plans, from 401ks, and things like that. And the way the payroll companies all work is that at the end of the month, okay, what they end up doing is that whatever that you've saved towards the your 401k, they put it and they send it to the investment company at the end of the month or the beginning of the month. So that money usually goes in the first 5 trading days or so. So the first 5 trading days of every month tend to be a little bit stronger than the rest of the month. But it's really true in January, because a lot of people make their IRA contributions. Partnerships don't have to end up putting their money in evenly. So they'll end up a lot of times put their money in at the very end of the year. So there's usually a flood of money that comes in at the very beginning of the year. And that's why those first 10 trading days are so strong. If you take a look at January of 2009, remember, we were in this horrific crash from 2008. And here, let me just come over to here and do this. If I say S&P and we come and we make this not 5 minutes, but let's, you know what, and let me do this on the monthly. You know what? Can I go, how far can I go back? That's just 1 year. Okay. If I come back and I take a look at the, the most horrific bear market that many of you have ever lived through, okay, if you take a look at this huge bear market, okay, that happened through 2007, the end of 2007, through all of 2008, the big crash in 2008, and the continued sell-off into 2009, if I highlight just January, okay, where's the end of January? The beginning of January is here. The end of January is here. We moved down a little bit, but nowhere close to the way the rest of the market is. If you take a look at for periods of time here, from mid-January through mid-February, we actually moved up. If you take a look at the first few days of 2009, look at how 2009 started, right? On a huge up day. And so I always take a look at the beginning of the years, and I know that there's noise. Okay. And so the fact that we have this very big, right, this very big movement higher over the last few days here at the beginning of the year, is it just, beginning of the year noise? Don't know. The market will tell us. There's an old saying that as goes January, so goes the year. Meaning, if January's up, the year will be up. There's another saying, as goes the January effect, the first 5 or usually first 10 trading days of the year is the way that the month will end up going, and they've been up. I think that we'll probably see more of a 2015 year where we'll probably end up having a lot of grinding higher, but we'll probably see some type of, I'm not going to call it a correction, but some type of non-trivial sell-off that could be 10% or more. Unless the economy changes, it'll find its footing and it'll end up moving, back up. But if we do see volatility, it's going to end up being in a lightning type of fashion where it'll hit very, very quickly. Okay. Thank you very much. And somebody ended up saying to me, their next IBMer. Yeah, for those of you who don't know, I spent the first decade of my career when I got out of college with IBM. And so us ex-IBMers tend to be very, I'm going to call it pragmatic, not engineers pragmatic, but usually pretty pragmatic in taking a look at how to end up looking at things both theoretically and how to end up actually putting into practice. So thank you. And I look forward to seeing you guys on Thursday. If you can't end up joining me on Thursday, it will be back here next Monday at 10 a.m. Eastern. Thanks, everyone.